So, an earnings report just dropped from a company called Stran Company. Their ticker is SWAG, which is pretty great. Now, on the surface, the numbers look absolutely explosive. But is that the whole story? Today, we're going to decode this report, get past those big headlines, and find out what's really going on with the business.
You should think of an earnings report less like a boring spreadsheet and more like a story. It's got its heroes, its villains, and definitely some cliffhangers. Our job together is to kind of be the detectives and figure out what that story actually is. So let's start with the big headline for Strand & Co. this year.
All right, first up, the headline. And for Strand in 2025, that headline was all about one thing, and one thing only, just absolutely explosive growth.
The very first number that just jumps off the page is the big one: total revenue. For 2025, Strand pulled in over $116 million. Now, that's a huge figure for a company this size, but the real question is, where did that all come from?
And here's where that number gets really interesting. As you can see on this chart, that $116.2 million bucks represents a massive 40.6% jump from the year before. I mean, just look at the difference between those two bars for 2024 and 2025. That is not gradual growth. That's a rocket launch in just 12 months.
And hey, don't just take my word for it. The CEO himself, Andy Shape, called 2025 a defining year. When you hear language like that coming straight from the top, you know these numbers are a big deal. So that leads to the obvious question: how on earth did they do it? So let's get into the how. A 40% jump in revenue doesn't just happen by magic, it's all about strategy. We need to kind of pop the hood here and see what's really powering this thing.
Well, it turns out their growth came from two very different places, as you can see here. On one side, you've got their core business, the promotional products they've always sold. That part was actually growing really nicely on its own. But then they added some serious rocket fuel with a major acquisition. Now, folding another company in is always a bit of a gamble, but man, in this case, it totally supercharged their results. So you have this really powerful combination: a healthy, growing core business that's been supercharged by a major acquisition that's now fully plugged in. It's a classic 1-2 punch for rapid expansion.
But, no story is ever that simple. This explosive growth is fantastic, but it came with some serious challenges hiding just beneath the surface. Let's take a look at the headwinds the company was actually fighting against. Because that massive revenue number, it's really just the tip of the iceberg. The real story of Strand's health as a business, well, that lies underneath, in the challenges they were facing while trying to grow so darn quickly.
It turns out Strand was fighting a battle on three fronts. First, you had tariffs, basically taxes on imported goods that were driving up their costs. Second, all the uncertainty about those tariffs made some customers pretty nervous about placing big orders. And third, they had over $5 million in one-time expenses just from things like being a public company. With all that pressure squeezing their profits, you'd expect the bottom line to be a total disaster, right?
Well, this is probably the biggest surprise in the entire report. Despite all those costs, just look at the turnaround on this table. First, their net loss, that's the bottom line number after every single bill is paid, was slashed by over $3 million bucks. And even more impressively, look at EBITDA, which is a quick way to measure a company's core profitability. They went from losing $3.6 million to actually being in the black. That is a nearly $4 million swing, and it shows the business itself is getting so much healthier. So that brings us to the final act of this story. What comes next? They've managed this incredible growth and a major profitability turnaround. Now, what's the playbook to keep that momentum going into 2026?
So management has laid out a really clear 4-part playbook for 2026. First, focus on their biggest clients. Second, build more of that reliable, recurring revenue. Third, keep investing in new tech. And fourth, stay on the hunt for smart acquisitions, since their industry has a ton of smaller companies they could potentially buy up. Okay, let's quickly demystify that key term they used: programmatic revenue. What does that actually mean? Well, essentially, it's about making themselves indispensable to their clients. So instead of just selling a client a batch of t-shirts for one event, they want to manage that client's entire e-commerce store, their warehousing, their loyalty programs, the whole shebang. They want to become a deeply embedded partner. And this is crucial because it creates recurring, predictable revenue, which is exactly what investors love to see. So after digging through all the numbers, the CEO's comments, and their future strategy, what's the one big takeaway we should leave with? What's the bottom line? For me, this is it. The story of 2025 wasn't just about that explosive revenue growth. It was about translating that growth into a fundamental improvement in the company's health. That swing from a big loss to positive EBITDA, especially with all those headwinds they were facing, is the most important part of this entire report. So this leaves us with the million-dollar question for 2026, doesn't it? They've built the growth engine. They've started to fix the profitability. But now, can they put it all together and deliver consistent, real profit? That is the chapter we'll all be watching for next year.